So, get this. What if I told you that a political insult, a nickname, ended up becoming a viral Wall Street trading strategy? Well, that's exactly what happened with something called the taco trade. It's this wild playbook designed to make money off of political chaos. Today, we're going to break down how it works, whether a regular person like you or me can actually profit from it, and maybe most importantly, where the whole thing just completely falls apart.
And it all started right here. This was the president's response back in May of 2025. A reporter asked him about a new, pretty unflattering nickname that Wall Street had come up with for his negotiating style, and, well, you can tell it really got under his skin.
And that nickname was TACO. It's an acronym that stands for Trump Always Chickens Out. It was coined by Robert Armstrong over at the Financial Times, and the strategy was deceptively simple. When the president makes a huge threat, say massive new tariffs, the market tanks. That's when traders jump in to buy the dip, betting that he would eventually, back down. And when he did, the market would shoot back up and they'd sell for a nice, tidy profit.
I mean, you can see why this was so alluring, right? The logic was so simple. It almost felt like a cheat code for the market. Like someone had finally cracked the code and was handing out the secret playbook to navigating all the volatility.
And this is that playbook in action. It's like a four-step dance. Step 1, a big, scary threat gets made. Markets go down. Step 2, the smart money comes in and buys everything on sale. Step 3, the threat gets walked back and, surprise, surprise, the markets rally. And then, step 4, you sell that rally and pocket the difference. This simple little cycle was the absolute heart of the taco trade. And you know what? For a while there, it really seemed to work like a charm. This whole cycle became so predictable that some Wall Street firms literally started building computer models to figure out the administration's pain threshold. Basically, how much did the market have to bleed before they'd reverse course? Insane, right?
But, and this is a big but, this is where the story you see on TV starts to diverge from reality. To really figure out if an everyday person could actually win at this game, we gotta look past the hype. We have to dig into the cold, hard data.
Which really brings us to the million-dollar question for anyone managing their own money, right? Is frantically glued to your screen, trying to time these political bombshells, is that really the smartest way to invest through all this chaos?
And boom, this chart pretty much says it all. The answer is fascinating. Over a 15-month stretch, these hyperactive TACO traders, the ones trying to perfectly time every dip, they made an 18.2% return. Not bad. But look at this. Investors who just did a simple buy and hold, meaning they did absolutely nothing but ride out the waves, they earned 17.7%. We're talking almost identical returns for none of the stress and none of the trading fees.
So the biggest risk wasn't actually missing out on the big rally. The real danger, the number that should really get your attention, is this one. The panic traders, these are the folks who sold when things got scary and only jumped back in after the coast was clear. They actually lost 1.4% over the same time frame. This just flips the whole script, doesn't it? Winning in this kind of market wasn't about being a market timing genius. It was about having emotional discipline. The single worst financial mistake you could make was giving in to fear and selling right at the bottom.
Now, you know how it goes. As soon as a strategy gets popular, Wall Street finds a way to crank up the risk. More advanced and way more dangerous tools started to show up, and they brought some pretty nasty hidden traps along with them.
By 2026, you started seeing these specialized investment products called ETFs pop up. Think of funds like AIBU and AIBD as steroids for your trades. They're leveraged, which means they're designed to give you double the market's return, or of course, double its losses. It was a way to bet big on the swings, if you had the stomach for it.
But here's the massive catch with these complex tools. It's something called path dependency risk. Now, put simply, when the market is whipping up and down like crazy, the weird internal math of these funds starts to work against you. This compounding decay can actually eat away at your money, meaning, and get this, you can actually lose money even if you guess the market's direction right. It's a brutal trap that a lot of retail traders fall into.
And all of this brings us to the fatal flaw, the ultimate limitation of the entire TACO theory. See, it's a strategy that works perfectly for a very specific kind of problem, but when the crisis itself changes, the whole playbook can fail, and fail spectacularly.
The whole strategy is built on one core belief, that policy threats, like tariffs, can be erased. You can undo them with a new rule or even just a social media post. But that logic completely breaks down when you're faced with a real-world military conflict like the 2026 US-Israel war on Iran.
I mean, just look at this comparison. Tariff threats? Their impact is mostly psychological. It's reversible. A kinetic war causes physical, tangible disruptions to things like global oil supplies. You can't just tweet away a bombed-out oil refinery. You can't unsink a tanker.
As Marko Kolanovic from JP Morgan put it so bluntly, you just can't reverse this kind of damage with a tweet. Unlike a policy threat, physical destruction is often permanent, and the market knows the difference.
So, okay, after all that, after the hype, the data, the very real dangers, what is the actual winning strategy? For a regular, do-it-yourself investor who's just trying to get through this kind of world, what's the right move?
Well, it really just boils down to a choice between these two mindsets. On one side, you have the taco trader. They're trying to time the news, making these huge, risky one-way bets. On the other side, you have the disciplined investor. They're focused on avoiding panic, on hedging their bets through diversification, and on prioritizing long-term stability over a short-term gamble.
So, let's boil it all down. For any DIY investor out there, here are the key takeaways from this whole mess. Number 1. Avoid panic trading like the plague. It is the single most destructive thing you can do. Number 2. A simple buy and hold strategy was shockingly effective. It gave you almost all the reward for none of the risk. 3. Be incredibly careful with those leveraged ETFs. The hidden risks can wipe you out. And finally, number 4. Focus on building a strong, diversified portfolio instead of trying to outsmart the 24/7 news cycle.
Which kind of leaves us with one last big question to think about. When the entire market is hanging on trying to guess whether a leader is bluffing or not, what's the true long-term cost of living in this post-credibility world? It's something every single one of us has to consider.